Okay. Now, tax planning, tax evasion, tax avoidance, right? And I told us then that there are slight differences amongst all of them. Now, when we say tax planning comes before you take up a transaction. Why tax? The difference between tax planning, I believe you know tax planning and tax evasion. What is tax planning? What's tax evasion? Let's start with that. I mean, tax avoidance and tax evasion. What do you understand by that? In short words, please. Yes.
Hello, sir.
Yes, go ahead, please.
Oh, okay, sir. With my little understanding,
What is tax
I
planning? I
can
mean, tax
demystify that. Which one? Tax
avoidance.
evasion. With my little understanding. Okay, tax avoidance.
Mm,
Tax avoidance. With my little understanding, I see it as a scenario where the taxpayer is trying to maybe reduce the tax liability.
okay,
The taxpayer is trying to dodge. He want to pay, but he's trying to make sure that he reduces his tax liability as much as possible.
okay.
Why tax evasion is a situation where the taxpayer doesn't even want to pay tax at all.
That's wrong. Yes, next person. But I want us to be very fast on it, so I will not waste your time at all on it. That's wrong. The two of them are willing to either not pay tax at all or pay a lower tax liability. The two of them. So that's wrong. Anyone? Tax evasion and tax avoidance. Anyone?
Just to say that tax evasion is criminal and tax
Uh-huh.
avoidance is legal.
Yeah. That's the difference between the two of them. Tax avoidance is legal, but tax evasion is criminal. And like I said in our last class, I said tax avoidance can later be criminalized at some point where reasonable care is not taken. Are we together? Tax avoidance can be criminalized at some point where uh where care is not taken, and the only thing we see that you want to do is just to reduce your tax. That's the only thing you're after. All right. Yes, it can be criminalized. Now, the two of actually tax avoidance is meant to be legal, and it is legal. Hello. Tax avoidance is meant to be legal and it is legal. But like I said, it can get to a point whereby tax authority will disallow it because they feel like the reason you are doing it is to avoid tax. Now, let's go into tax planning. And I'll tell you the difference between tax planning and tax avoidance when we get there. Now, tax planning is a conscious effort, which is also legal. A legal and conscious effort of a taxpayer to organize your financial affairs, your income, your expenditure, your recurrent expenditure, your capital expenditure, your investment, to organize them so as to minimize tax liability within the confines of the law. Of course, you can think this is also tax avoidance, right? Now, there's a difference between tax avoidance. Let me quickly explain. Let me quickly define tax avoidance as we have it here. Under tax avoidance, a taxpayer also arranges his affairs to reduce or avoid tax liability by exploiting loopholes or taking advantages of provisions in the tax law. Now, the two of them are to take advantage of the tax law, provisions of the tax law. All right. But one of them is that the transaction has already occurred. You've gone into that transaction, you've purchased that asset, right? You've incurred that expense, you've earned that income. Before you start thinking of how to reduce your tax liability, looking at the various loopholes in the provisions of the law to reduce your tax liability. The transaction has already been done. That is tax avoidance. But for tax planning, before you go into the transaction at all, you're already planning what the tax liability will be. For instance, we know change of accounting dates, right? Can you remember change of accounting dates? The principle of
Yes,
change of
sir.
accounting dates. Can we remember?
Yes, I can remember.
Okay. Now, for change of accounting dates, you agree with me that there is a cost. All right?
Yes, sir.
There is a cost. Now, this cost that we have is that you will pay a cost for changing your accounting date from 1 year to another, and that's why you pay the one with the higher tax liability. All right? You pay the one with the higher tax liability, and that's it. Now, in the same way, because of that, tax consultants, tax practitioners, they look at when is the best date for you to change your accounting year end that will result to a lower tax liability. They will now decide on that date before you change your accounting date at all. Do you understand? So doing it before the transaction is tax planning. But after the transaction has occurred, you are now looking for ways to reduce your tax liability, then that one is tax avoidance. All right? Now, the features of tax planning is that it is done, tax planning is done before a transaction occurs. Okay? And it requires in-depth knowledge of tax laws and incentives. In-depth knowledge of tax laws and incentives. And it makes use of allowances, exemptions, reliefs, timing and structuring of transactions. So that's what we have on tax planning. Now, the specific strategy will now be to choose a favorable accounting year end. Remember, I mentioned it under change of accounting dates, right? To choose a favorable accounting year end, to time when to acquire your assets and dispose your assets, your qualifying assets. All right? Then also to decide when to claim capital allowance. You can decide that you're not claiming your capital allowance now and claim it later. But there are some capital allowances you cannot defer. Am I right? You have a capital allowance you must claim in that same year. Do you know that capital allowance?
Investment.
Investment.
Investment allowance. Investment allowance can be deferred.
Petroleum.
Eh?
Petroleum.
Initial allowance.
Initial allowance can be deferred. Investment allowance can be deferred. Do you want me to show you where you can defer investment allowance?
Yes, sir.
Have you done pioneer status?
No, sir.
Okay. When you do pioneer status, you will see that initial allowance and investment allowance can be deferred. And that's it. Now, the only allowance that cannot be deferred to the next year is rural investment allowance, not just investment allowance, rural investment allowance. Yeah, rural investment allowance cannot be deferred to the next year. You have to claim it as it hot. Do you understand? You have to
But
claim rural investment allowance. Ma?
I thought it has been scrapped.
Rural investment allowance.
Yes, I think that this thing, tax finance act of
2020
2000.
tax law. I don't know if rural investment allowance is scrapped though. The one I
Yeah,
know that was scrapped.
investment allowance and rural 2023 Finance Act.
You call it? What do you call it?
2023 Finance Act. That's it.
Scrapped what?
Investment allowance and rural investment allowance.
Okay, the one I know that was scrapped is initial allowance and investment allowance.
No, initial allowance is not scrapped. It's only investment and
Are you sure?
yes, sir. But check, maybe there's an update. I mean, I
Initial
don't.
allowance is scrapped. They've scrapped the initial allowance. There is nothing like initial allowance again.
From this
Initial
current law
allowance,
now, it's
I'm very sure.
2023.
Yes, it's true. It's true.
Which one is true?
The initial allowance.
Initial allowance, I am very sure. Initial allowance and investment allowance is scrapped. I did not read
With
the
effect from when, sir?
Sorry?
With effect from when, please?
With what?
With effect from when, sir?
From the new tax law, from the new capital allowance. When do we have the new capital allowance? Is it not NTA? It's still in NTA. This NTA 2026.
Okay, that's what I'm saying. Going 2023, we're still doing investment allowance, initial
No,
and the others.
no, nothing happened to investment allowance till last year. Initial allowance, investment allowance, nothing happened to them last year. This new tax law is what scrapped them. This new tax law that was signed in July. Are we there?
Yes, sir.
So, but you can confirm whether rural investment allowance has been scrapped. But me, personally, because I presented the difference between the new tax act and the old one, I presented it sometimes last year, around July or August, in one of my management meetings. Yeah, I presented it, and I'm very sure initial and investment allowance is scrapped. But rural investment allowance, I don't know, and I'm not sure. So that is it. Now, all other allowances are to be claimed immediately. But when we see hard initial allowance and annual allowance, all of them can be scrapped. Right? So that's it. Are we there?
Yes, we are.
So that's what we have.
Yes, sir.
Now, so timing, you look at the timing and structuring of your transactions. All right? And you claim on your allowance at the very right time. So that is tax planning. All right? So you look at the time of your accounting year end, when to claim your allowance, you consider lease versus outright purchase. We know that one, right? Lease versus outright purchase. Now, then also you have incentives, tax incentive sectors, right? Like pioneer status incentives, EPZ, gas utilization, road infrastructure, credit scheme, and the rest of them. And I don't think government can scrap rural investment allowance. Insofar there are rural areas in Nigeria, government cannot scrap rural investment allowance. Yeah, government cannot scrap it. All right, that's
But
it.
the conditions can be modified, sir.
The incentive, the allowance
The
can be modified.
conditions for granting. No, the
Yeah,
conditions for granting rural investment, they are not relatable. Right?
What's the condition? What's the current condition?
I don't know about the current conditions. Talking
No,
about
there is a
the
condition.
conditions
The
that
current
were
condition
granted.
is that the current condition is that your investment must be located in an area that is 20 kilometers away from government facilities. Right? They changed some of the conditions then. Some of the items you can claim rural investment allowance. Before, you can claim rural investment allowance on telephone. I mean, but now it is no more. When you bring telephone to an area, You can claim rural investment allowance on it, but now you can't. So they can amend, they can change some of it. But those ones that are there now, we have electricity, we have third road, and we have water. You will not tell me that it is everywhere in Nigeria that has electricity. If I invest in such an area, government must give me the allowance. A third road will bring investment. Oh. All those infrastructures, they will bring investment, right? And that's why government is giving an allowance, giving a allowance on it in the first place, because they are expected to bring investment. So they can now say that if you bring water, like that of water now, government can modify, they can amend it, because it is assumed that water is everywhere. But it's a lie, water is not everywhere. But we are thinking that the cost of bringing water to an area is not that expensive anymore. Borehole is not so cheap, but borehole is available. You can make borehole available, right? So that's why. But aside that, government can modify it and change some of the things, like that water, right? But that's it. Now, that's not where we are going, actually. Now, let's come back. So you also look at structuring your employees' remuneration to optimize tax, and also to monitor compliance deadlines, like when to pay PAYE, withholding tax, value-added tax, your statutory annual filing, right? So you look at those things. That is tax planning. Now, tax planning is legal and encouraged, but tax avoidance is an exploitation of loopholes. Sorry, this noise, I need to clear it. Tax avoidance is an exploration of loopholes in tax laws. Are we there? So the loopholes in tax laws is what you want to reduce under tax avoidance. And that's it. Now, 1 second. Okay. Now, tax avoidance key point is that it is legal, but it is seen as aggressive. Some people can be very aggressive to the point that government will say, because you are looking for this, and because you become too aggressive, you can fall into tax evasion, consciously or subconsciously. And that's why it is discouraged. It is based on form rather than the substance of transactions. All right? It is based on the form of transaction, not the substance of that transaction. An example of it is avoiding VAT by not buying a vatable goods or services. Do you want to compare that to tax planning? Do you want to compare that one to tax planning? Are we together? So that's what we are saying here. You will not compare that one to tax planning. And that's why we are saying that tax avoidance should be avoided. Now, it also makes use of front investment income to avoid additional company income tax on dividend. You understand? Yes, when you use a front investment income to pay company income tax, to pay dividend, of course, you will not pay tax on that dividend now, on that aspect that you have paid. Am I right?
Yes, sir.
So that is tax avoidance. It can become too very aggressive. All right? And that's it. Now, the legal backing for it is a court case. There was a court case between Ashure Pullman Motor Service and CIR. And the court upheld that taxpayers are entitled, yes, Taxpayers are entitled to arrange their affairs to pay the least tax possible, provided that it is within the law. Do you understand? We are not saying you should not claim it, though. Provided that it is within the law, please, you can claim it. All right? But the thing is that we don't want you to become aggressive of it. There are cautions, right? And the cautions are, number one, when transactions have no commercial substance. Can you see that? The transaction has no commercial substance. You are only in that transaction, you only went into that transaction in order to avoid tax. FIRS can disallow it. Are we together? The only reason you went into that transaction is to avoid tax. FIRS can disallow it. I hope I'm making a sense here. No be me talking more, now your book talking more. I hope we are together. Eh?
So I give an example.
Example.
Yes, sir.
Okay, now let's say you bought an asset, motor vehicle for your company, and the only reason you have purchased that motor vehicle is to claim capital allowance on it. You are not using it for anything in the business. It's more like a private car for your boss. Private. And when I say private, private means you can use it for anything outside business. You can decide not to bring it to the office and take it to another one there. Right? You can go to club with it. It's your car. That's a private car. But the only reason you have purchased it in the name of the company is because you want to avoid tax. So in a situation like that, the transaction is not for the substance. It's not for any commercial substance. It is only to avoid tax. All right? So that's it. Now, because of something like that, when government sees that that's what you do, they can disallow it. It can lead to anti-avoidance legislation. That's when they know that, okay, this is what you guys are doing. That you are making use of a loophole to reduce your tax liability. Government will now bring in a new tax law that will block that loophole. Let me give an example of that, something like that will block. Pension. Voluntary pension. Do you know what voluntary pension is?
Yes, sir.
And you know that voluntary pension before, even till now, voluntary pension is not taxable.
Yes, sir.
Right? But there is a clause attached to it now. All right? And the clause is that you cannot withdraw the money you have kept in that account that is less than 5 years. You cannot withdraw that money. That's the clause for voluntary pension, because people were using, Nigerians were using that, they were using that platform to evade payee. Because they don't want to pay payee, they will transfer all their salary to voluntary pension, and immediately they go to that voluntary pension account to withdraw the money because they had access to it. But now, if you withdraw the money before it completes 5 years, you pay tax on it. Are we together?
Yes.
Aha. So that is a loophole. That is an anti-avoidance legislation. And tax avoidance is legal, but
Please, hello, sir. Please repeat what you said. If they withdraw it before 5 years, they will pay how much?
Your voluntary pension. If the money has not spent up to 5 years in your account, let's say, for instance, now you have voluntary pension that you are saving for, right? Now, this voluntary pension, how should I put it? So that voluntary pension, you have it in your account in the last 4 years. Now, this is the 5th year. That money in your account, if this is the 5th year and you withdraw everything in that account up to today, everything in that money that is not up to 5 times 12 is what? 60.
60.
The money must have stayed in your account for 60 months. If the money has spent 59 months and some days, they will charge you tax on that one that is not up to 50 months. Let's say out of the 10 million naira you have in your account, pension account, you started 5 years ago, which means the first one you deposited, let's say you started in April 2021, April 2021. That means that April 2021 completed 60 months in March 2026. Is that not 5 years?
Yes, sir.
Completed 6 months in March 2026. That is March ending, March ending 2026. Now, let's say the money was deposited in, let me say, in May. Let me start from May. May 2021. Now, that means the money will be, I want to use March 2021, not May. March 2021. That means the money completed 60 months. The one you deposited in March 2021 completed 60 months in February 2026. The one you deposited in March 2021 completed 60 months in February 2026. Am I right?
Yes, please.
Yes, sir.
Now, that means in 2026, in March, you can only withdraw that one you deposited in March 2021. If you deposited, if you withdraw what you deposited in April 2021 today, if you withdraw what you deposited in April 2021 today, you'll be subject to tax. So imagine let's say every month you are depositing 100,000 into that account. Now, the one you deposited in March 2021, you can withdraw it today in March 2026. But you want the one you deposited in April 2021, if you withdraw 200,000 today, that 100,000 that you deposited in April 2021 will be subject to tax. That is what we mean. So that is that. Now, tax evasion. Tax evasion is deliberate and illegal action taken by a taxpayer to escape tax or also underpay tax. Do you see why I said you were wrong earlier? All of them are to either reduce tax or not pay tax at all. All of them. But one is illegal. The illegality of tax evasion is what distinguishes tax evasion from others. Are we together, please? Let's go ahead, please.
Sorry, sir. Thank you, sir. So, sorry for drawing, but I just want to confirm something on that voluntary pension. Okay, does that mean that if the money is not there for up to 60 months, is it going to be subjected to tax like normal payee, the way we tax payee?
Yes, sir.
Okay, thank you, sir.
It is subject to tax like normal payee. Even director's fee now is no more 10% withholding tax again, right? Director's fee is not 10% withholding tax anymore. All right. So director's fee is now is it not 15% or 20% to give room for what do we call it? What do we call it? The new tax law. So that is it. Now, example of tax evasion: failure to register for tax, not filing tax returns. Right? Then what else? Under reporting of income, inflating your expenses, and falsifying your records, bribing tax officials to ignore tax obligations. All of these are, what do we call it? They are all tax evasion. All right. So that's it. Any question from anyone, please? Any question? That means we can go on. Abi? Nobody is answering me.
Yes, sir. Yes, sir.
Yes, sir.
Mhm. It means we can go on. So that's it. Now, the key point is that tax evasion is a criminal offense under Nigerian law. Yes. And it attracts penalties, fines, and imprisonment, and it is considered unethical and punishable. So that is that. Now, all of these summaries, we can look at them. We have tax accounting and tax reporting. This is another chapter. Tax accounting and tax reporting. Are we together, please?
Yes, sir.
Yes.
Okay. Now, tax accounting has to do with a record of all your tax transactions, all your tax, all right, your tax record, and the movement in the company's tax transaction, all right, your tax record and your tax transactions. That's what we have here. Are we there?
Yes, sir.
Okay. Now, it is advisable that you maintain a separate ledger, of course, for it, right? For each type of tax you are paying. Yeah, you should have an account for withholding tax, value-added tax, company income tax, all separate. Yes, you should do that. Now, the typical content of your tax account will now be unpaid tax at the beginning of the year, something like deferred tax, have you? Is it also?
Yes, sir.
Aha. So something like your deferred tax will be there. Then, of course, we have provision of company income tax, right? Then provision of tertiary education tax. What did you pay on tertiary education tax? All right. Then, of course, we have prior year under provision, right? Under provision for tax. So you need to have that as well. Over provision, you have it. You have tax payments during the year. Are we together? You have your tax payments during the year. You have your provision for deferred tax liabilities, right? You have your provision for deferred tax assets. Please hold on a second. Just 1 second, please. Okay. Yeah. Deferred tax assets, your withholding tax and credit note set off. You have to have that as well. Okay. Unpaid tax at the end of the year, you should also have that. Now, we have the posting into the tax account. All right. Your journal entries, please take note of your journal entries and trace them. Now, I'm going into deferred tax, which I'm sure you've done before in your SBR. All right. So I will not do much on that. Now, deferred tax. Deferred tax arises from temporary differences between your accounting profits and taxable profits. Accounting profits and taxable profits. All right. So that's it. Now, this deferred tax can be an asset and it can be a liability. Now, deferred tax asset is a tax that you can recover in the future. Tax recoverable in future due to deductible temporary differences. All right, due to temporary differences, and that's it. Now, deferred tax liability is also a tax payable due to temporary differences. Now, the objective of studying deferred tax and deferred liability is to match your tax expense in your profit and loss account to the accounting profits of the period. All right, yeah, that's it. Now, computation of deferred tax. Now, deferred tax, we say, is a temporary difference. Temporary difference in your tax payment. Now, what is that temporary difference? There's something called net book value. Abi, what is your net book value?
Cost
Eh?
of assets minus accumulated depreciation.
The carrying
Can
amount.
Yes, sir.
What do you say? What do you call it? I did not hear you.
So net book value is the carrying amount or the book
Okay.
value.
Now, net book value is a carrying amount, right? Which is your cost minus depreciation, Abi, or accumulated depreciation, Abi.
Yes, sir.
Yes, sir.
Yes, sir.
Now,
Yes.
your net book value. The same thing, what reduces your net book value, what reduces the cost of your assets to net book value is depreciation. Abi? Now, tax
Yes, sir.
authorities think that no, we are disallowing depreciation. Instead, we are giving you capital allowance. Right? Now, cost minus that capital allowance you have claimed, we give you tax written down value. Abi?
Yes, sir.
So which means the similitude of net book value in your FA, your financial reporting, is tax written down value in taxation. Right? It is tax written down value. We call it tax written down value in taxation, and we call it net book value in your what? In your FR, financial reporting. Now, the difference between the two of them, right, multiplied by the tax rate. Now, when your tax written down value is higher than your net book value, it means you have more capital allowance to claim from the government. Capital allowance is the tax written down value means the remaining claimable capital allowance, the capital allowance you have to claim in the future that you have not claimed. Net book value also means total asset minus depreciation, right? The value of the asset. Now, what we are saying is that when your tax written down value is what you are expecting from tax authority. Your net book value is your own provision from your own end. Now, when your tax written down value is higher, it means you are expecting more capital allowance from the government than what you have. You don't understand what I'm saying? Hey, you don't understand?
We
Do you understand?
Yes, sir.
Okay, so that is a deferred tax asset because you are expecting more. What you are expecting from tax authority as capital allowance is more than what you have in your balance sheet. Definitely, it's called a deferred tax asset. But when your net book value is higher, then it becomes a deferred tax liability. A tax calculation question, and this is the formula. Tax in value minus net book value times the tax rate. Right? So that is that. Now, some of the things that can cause this is when you have revaluation. Now, when you have revaluation, you have to adjust your MDV for the revaluation. Now, revaluation is that you are not using net book value. When your revaluation amount is higher than your net book value, or even if it is lower, you have to use the revaluation amount. That's it. So adjust net book value for revaluation surplus before applying the formula. So that is it. Now, The journal entries, please go through them. It's not me and you that will do that. But for your tax, your tax account, this is how to, this is the format for your tax account. Too. This question comes out too, and different tax comes out. This tax account also comes out. Your income tax profit, your income tax on profits before tax. This is it. Lecturer education tax. Lecturer education tax is now 3%. This is it. All right. Then prior year under provision, you under provided for your tax. That means you need to provide for more. It's an expense. Right? Deferred tax charge. Deferred tax, either a charge or a credit. That is an asset or a liability. Is there? And also you have your profits. You have your tax as per P&L account. Now, if you have outstanding debt at the beginning of the year, you add it. If you have a deferred tax adjustment, you add or supply depending on what you have. Okay. Then also, if you have minus tax you paid during the year, whatever you get, we give you what do we call it? It will give you your. I need to bring this back. Now, whatever you get, we give you your tax as per the financial position, and that is it. Now, the risk of wrong or misleading tax disclosure. When you give a misleading tax disclosure, a misleading tax liability, you give tax authority a wrong account, right? Now, in a situation like that, financial statement must comply with financial reporting, your IFRS and GAAP. Taxes are material items. It's just tax now, and the money is very small. It's a lie, oh. It's a lie, oh. Right? That's it. Now, then also, wrong tax disclosure can mislead users, that is tax authority, investors, and auditors. And then tax professionals must verify reliability of financial statement to reduce risk of reliance on incorrect data. So your tax professionals must verify your tax account. And that's what we have there. Now, so the nature of your tax now, the nature of your tax is based on the current year, and for current tax is based on the current year. Deferred tax is based on the timing difference, right? You recognize your current tax in your P&L account. Deferred tax can also be in your P&L account. All right, for balance sheet, for liability, you present your tax liability, your asset or liability. You don't present anything. Your current tax is not a liability. All right, it is not a liability until you default and you are unable to pay. That is when it becomes a liability. Now, we want to go into, are we still doing solid minerals? Are we still doing solid minerals or hydrocarbon tax? I think we now have hydrocarbon tax. So.
We have hydrocarbons, sir.
Yeah, we
Yes,
have.
sir. Hydrocarbon.
So yes, we still have solid minerals too. We have solid minerals, we have hydrocarbon tax. Now we'll go into solid minerals today as well as hydrocarbon tax. All right. Now in our next class, we'll solve a question, or should we just solve a question on different tax now? Let's solve a question on different tax today. Do we have any recent question on different tax? Like 2020 downwards, down to today. Do we have? Do we have any question? Has anyone seen any question on deferred tax? Advanced tax, sorry. I can't find deferred tax for a tax. Okay, tax planning is also here for non-residents. Tax planning is theory. I've seen a deferred tax question before, but I don't know where. I've seen a deferred tax before, but I don't know where. Okay, let's go into solid minerals. Maybe when we are solving our past question, we'll have a question on deferred tax. Now, for solid minerals, right? Solid mineral taxation is saying that a taxation guideline on how to manage our solid minerals. All right, so we need an effective tax policy to ensure that extraction of natural resources benefits the economy and the society while addressing environmental and social impact. There is this agency that government has on solid minerals. Yes, go ahead, please.
Okay, sir, I can find one for one question for deferred tax. I
What
think
day?
is November 2022.
November 2022. Please, let's do it now. November 2022. Do you know the question number? Even if you don't know it, don't worry. I'll get it now. Pioneer is question 1. Anytime I see Pioneer questions, I'm always happy. Question 2. I like this one too, hydrocarbon. Question 3 is on CG.
Okay, question 7, sorry. Question 7.
That's fine. Question 4 is transfer pricing. Please, you guys should look at question 4 of that November 2022. It's on transfer pricing, question 4. Then we have question 5. Aha. Question 5 is on, what do you call it? Merger and acquisition. Yeah. Question 5 is merger and acquisition. Question 6 is other tax incentives. And question 7, this one is only asking for the deferred tax provision. Question 7B is only asking for the provision. Question 7 is only asking for deferred tax provision.
Okay, the rules that's
There's one calculation question I solved. One diet like that. Can't remember the diet. Okay, let's go to mineral. To minerals. Now, taxation of solid minerals, right? Now, now I remember. We have NATI, National Extraction, is it National or Nigerian Extractive Industry or something, NATI. Who remembers NATI? Now, NATI is there for all extraction companies that are into extraction of minerals, solid minerals, and raw materials, and crude oil. All these extractions, companies that are into extraction, they have NATI. Now, NATI is to monitor their transactions, monitor their outputs, their inputs, right? In fact, NATI has a special external auditor for them. Yes, there is an auditor, external auditor. It's not done by Auditor General for the Federation, no. Even if it comes from the Auditor General for the Federation, it has to be specific for NATI, right? National Extractive Industry, something like that. All right. So that's it. Now, So we want to ensure that they
Sir,
are
it's Nigeria Extractive Industries Transparency Initiative.
transparency initiative. Yeah. Nigerian Extractive Industry Transparency Initiative. That is, we want to be sure that they are transparent in their transactions, right? They are giving government the accurate record of their extractions for a particular period of time. Because government is asking them for this extraction. How many have you extracted? How many quantity? What quantity did you extract in a particular period of time? Government is interested. All right. So that's why we have NATI, and they have their own tax auditor that audits their financial statement. All right. So that's it. Now, so what we need to do is that I want to address environmental and social impact. All right. And for this to happen, government must implement fair, transparent, and enforceable tax system, okay, to ensure that all stakeholders contribute to sustainable development. Now, solid mineral itself, the solid mineral taxation is a tax levied on the extraction, processing, and sale of solid minerals, such as gold, iron ore, coal, limestone, and other valuable resources. All right, and that's it. Now, the purpose of this solid mineral taxation is to ensure that government derive revenue from the exploitation of natural resources that belongs to you and me. National resources that belong to you and me. All right, which can be used for public goods, infrastructure development, and economic diversification. All right, that's it. Now, we also have the reliance. All right, in countries with abundant natural resources, solid mineral tax can take a significant part of government revenue. It's not taking any significant, well, it's still taking significant time because crude oil is also extraction, but crude oil is not solid minerals actually. And what's who is our minister for solid mineral? What's the name of that man? That Ekiti. Is it from Ekiti or Osun? But claiming Lagos State, working with not Kija, something. It was the former essay to Tinubu now. What's his name, please? You don't know the meaning of the name of your minister for solid minerals. What's this Yoruba name now? Something Ja, something Kija or something, but it's not Alakija. Is it Dele? I can't remember. You too, you cannot remember. And don't worry, let us leave it like that. Now, the types of solid minerals we have, right? We can have royalty, all right, which is based on percentage of your gross.
Lucky, daily, something.
Sorry, what do you call it? Daily alake.
Alake.
Alake. Daily alake. I don't know is alake is not alake.
Alake daily, yes.
Daily alake is daily alake. Thank you for that, sir. Now, royalty is a percentage of your gross revenue. Now, how royalty works is that you are using my assets, you are using my land, right? And I'll tell you that what I will be getting is anything you produce on that land, you give me 5 naira out of it. All right? Yes, that is the revenue that Obafemi Awolowo is seeing till today from Coca-Cola. And it's also the same royalty that former president, what's it called? Obasanjo, Olusegun Obasanjo, Baba Yabo. That's one of the royalty is receiving from MTN till today as well. So that's it. Now, we also have corporate income tax, right? Yes, corporate income tax is based on their profits, right? After removing all allowable expenses. Then we have severance tax. Severance tax is imposed on the extraction of non-renewable resources. Resources that once you extract, it cannot come back there, it cannot be renewed. All right, that is severance tax. Then also we have export duties. All right, now this one is paid when minerals are exported. All right, then also we can have environmental tax and levies, and this one is designed to mitigate environmental impacts of mining activities. environmental impact of mining activities. And that's it. Now, the legal and regulatory framework of this mining and solid minerals. We have the mining law, okay? Yeah, mining law and regulation that govern how minerals are extracted and taxed. We have it. We also have the tax administration to be NRS, right? NRS is responsible for the administration and enforcement of solid mineral taxes, and they ensure compliance with that law and also collect the revenue, the tax yield. Now, license and permits. Mining companies must obtain licenses, right? What's that license? I forgot, you know.
PMS.
PML, OML, OML, PML, yeah, which is mining license, yes. So that's it. Now, licensing and permits are there, right? And when you have that license, it permits you to operate legally. There are so many illegal mining companies in Nigeria, and that's it. Now, we have challenges in solid mineral taxation. Of course, we have tax evasion, and you can see tax evasion and tax avoidance, which means tax avoidance is a challenge. Do you understand? Now, due to the complexity of the mining industry, there's a risk of tax evasion and avoidance, where companies may underreport income or overstate deductions in order to reduce their tax liability. In one word, tax avoidance is also a challenge to government. And that's why there's always an anti-avoidance legislation that is being enacted. Then also, valuation issue. How do we determine the accurate price, the accurate value of minerals when prices can fluctuate? So that can be challenging, and it can result to a dispute between tax authority and the taxpayer or the mining company. Then we also have transfer pricing, of course. Now, multinational companies are usually into mining, are the ones that are usually into mining, all right? So they can engage in transfer pricing and then manipulate the prices of the transactions between among their related entities. So it can lead to profit shifting or base erosion. Base erosion or profit shifting. It can lead to any and the two of them. So that's it. We also have environmental impact. Yes. Now we know that for environmental impact is always negative. Social impact can be positive, but environmental impact is always negative. And that's it. Now we have land degradation, all right? So that can make government to tax and charge you additional tax. All right? Yes. So, and that fund is used for rehabilitation and cleanup. But of course, the tax cannot be fully collected. Okay? So that's it. Are we still together? Shall we proceed?
Yes, sir.
Yes, sir.
Yes, sir.
Okay. Now, we have best practice and recommendation. We have transparency reporting. All right? Transparency reporting. Now, transparency reporting is that government should enforce a reporting standard for mining companies that will be transparent enough to ensure that they declare their accurate income, their production volumes, and their sales. All right? That's it. Then also, there should be capacity building. Yes. That is, government should strengthen their own capacity, their own tax officials. All right? Teach them, let them learn. You can't give what you don't have. You cannot assess what you don't have any knowledge of. I used to say it's digital economy. Now mining. All right? So that's it. So they should ensure they strengthen their own capacity as well. Teach their staff on how to assess, collect, and audit solid mineral taxes in order to maximize revenue from that sector. All right. Then also, we should involve the community in the taxation and distribution of mining revenues. All right. Now, this can provide and promote sustainable development and reduce conflict. All right. Yes, let people in the neighborhood, let them be part of the tax authority. All right. So that is it. Now, also, you are to review and update the law. Yes, any outdated law should be updated in order to address emerging challenges and ensure that taxation keeps pace with industry development. Okay, then there should be environmental safeguards as well. All right, yeah, strict regulations that can ensure that mining companies contribute to the preservation and rehabilitation of the environment. And that is that. Now, the impact of this mining on the economic development. Number one, government can generate tax revenue from it. And it can result to economic diversification, whereby we don't focus on agriculture alone. We don't focus on crude oil. We focus on this mining as well. Then also, it can result to corporate social responsibility when it is properly managed. All right. It can improve the standard of living of the people in that area, create job, and reduce poverty. But basically, what I see these days is collapse of mining sites. So many mining sites are collapsing, and people are dying. People are getting stuck under, and it's becoming very unfortunate. We have one in Oyo State, another one in Nasarawa State, and it's happening like that. So that's it. Are we there? Are we there?
Yes.
Yes, sir.
Okay. Now, let's go into PIA, 2021 PIA. All right. Now, this PIA replaced PPTA, Petroleum Profits Tax Act. All right. Now, PIA has replaced it in 2021. Now, PIA is a landmark reform in the petroleum industry. All right. And it has addressed the inefficiencies in the legal and regulatory as well as fiscal framework of Nigeria's oil and gas sector. And it aims to enhance governance, increase government revenue generation, and also to stimulate investment. And that's it. Now, it replaces the Petroleum Act of 1969 and consolidates various laws that's governing the industry, and also provides a clear structure for the upstream, midstream, and the downstream sector of that economy. Now, the objective of PIA, we have governance and administration. Yes. So it has established a governance and a framework, a new regulatory framework that will be guiding the affairs of petroleum companies that are into extraction of petroleum products. All right. Then also the Nigerian Upstream, NUPRC, Nigerian Upstream Petroleum Regulatory Commission, now oversee the upstream sector and focus on exploration and production. What is the upstream sector? The upstream is where they extract raw crude oil. Do you understand? Are we there, please? Extraction of crude
Yes,
oil.
sir.
That is upstream, right? That's it. Now, we also have the midstream, where we have NMDPRA that regulates activities in the midstream and downstream. Now, the midstream and downstream, that's why when Dangote refinery had issues with yourself, with NNPC, right? It was NMDPRA that went to his refinery to inspect and investigate is fuel. All right. Are we there? So that's it. Now, we also have the fiscal framework, right? Now, the fiscal framework is, yes, go ahead, sir.
So please explain the downstream again. You mentioned that upstream has
Oh,
to do
okay.
with
You are right. I
crude
didn't mention.
oil. Yeah.
Okay. Now, main upstream is extraction of crude oil, right? Now, midstream and downstream. After extracting crude oil, they take it to the refinery, right? Now, upstream ends at where they drop it at the refinery. That is where upstream ends. Transportation to the refinery. And now, downstream and midstream, they are all the same. They are the ones in charge of refining it, which is Dangote refinery now, right? And those filling stations you see that is selling fuel, kerosene, diesel to you, they are all downstream. All right? They are all downstream, midstream and downstream. So that's what we have there. Now, I hope I've explained now.
Yes, sir. Sir, one more question, please.
Okay.
I'm sorry for taking us back to solid minerals, but you did not really explain the severance tax very well. You just said it's non-renewal resources. I don't understand what it means.
Okay, so severance tax is a tax that is levied on mining companies, all right, for destroying the land, for land degradation. Do you understand? Those things
Yes, sir.
that once you take them away from the land, once you extract them from the land, they are not renewable. You can't get them again. For instance, when you take crude oil from the land, another crude oil will still come there. Do you understand?
Yes, sir.
And another crude oil will still come. Do you understand? But there are some of the mining resources or natural resources that once you take them away from land, they don't come back to that place. So you pay severance tax on them. So that's it. Shall we proceed now?
Sir, can you give example?
Okay. Wait, where is that severance tax again, sir? Let me go to that severance tax. I'll let me think of one of the products. I'll think of it and I'll see it and I'll get it. Where is that severance tax? Is it not on that challenge? No. The taxes.
It's under types of solid minerals.
Yeah, I've seen it. I'm coming. Let me think of one. Okay. Don't worry, I'll get it now. Well, our minings, right? Our minerals, many of them actually cannot be renewed. Do you understand? Many of them cannot be renewed. For instance, now diamonds, right? Yes, diamond, uranium. Yes, many of them cannot be renewed. All right, like diamond now. Diamond, I'm very sure. Once you take diamond from a land, it cannot be renewed. Do you understand? I think gold too. There was a time they said they saw gold in Zamfara, Abi. And now,
Yes, sir.
gold, Abi.
Yes,
But
yes,
they
sir.
do. They have. Yes.
So once you I don't know if gold is renewable, but most of them are not renewable. All right. Yes. So diamond, uranium, I think copper too, copper and iron ore. I'm not sure, but at least I'm very sure of diamond and uranium. They are non-renewable energy. Once you pick them up, they don't come back to that point. All right. So that's it. Any other question? Any other question?
No, sir. Proceed.
Okay. Proceed. This is 10:29. We'll continue from here in our next class. We'll start from
Thank you, sir.
what do you call it? PIA, right? We'll continue from. No, I'm starting from hydrocarbon tax in our next class. Or we can still look at all these frameworks as well. So I'll see you in our next class. Good night, everyone.
Good night, sir. Thank you, sir.
Next class.
Thank you,
Enjoy
sir.
your
Good
weekend.
night, sir.
Weekend starts from
Good night,
tomorrow.
sir. Thank you, sir.
Enjoy your weekend. I'll see you all in our next class.